this out. Bitcoin, it broke through the $50,000 level just a short time ago. It's now up more than 70% since January 1st.
Where is it going? It's probably going to 100, then 150, then 200,000.
I'm assuming, Kathy, that you're going to hold to your Bitcoin forecast for, what is it, $1 million per coin by 2030. That still feels good to you?
Yes.
Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point.
Billions wiped off the crypto market when Bitcoin dropped below $30,000. It's still there. It's $29,500 right now.
Check out Bitcoin falling below $20,000 at one point today as the crypto crush continues. The entire crypto space still dealing with major losses this year.
The median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026.
Turning back to Bitcoin now, though, because we have the price within just a few $1,000s of an all-time high on surging optimism for demand. It just crossed $62,000 in the last few minutes.
Numbers, please.
Yes, January Consumer Price Index out in a few seconds. All yields are a bit lower, and here we're hitting the wires. Headline number expected to be up 0.2% is up 0.3%. That's the hottest since SEP of 23 when it was up 0.4%. Strip out food and energy, even hotter, up 0.4%. Also 1/10 hotter than expected.
The U.S. home prices hit an all-time high at the end of 2023. So if you've been shopping for a home and thought you were running into that, it wasn't just you. Seasonally adjusted data shows prices were up 0.2% from November to December. That continues a streak of 7 record highs in a row in 2023.
Well, oil prices slightly higher this morning after closing out a second straight month of gains. Joining us now to recap the moves that we saw in February and how that sets us up here for March is Inez at the big board. Inez.
Yeah, Shauna, and we are looking at oil that's up more than 2% for West Texas Intermediate, above the $80 a barrel level. That's the highest level for 2024, and it is the highest level that we have seen since November of last year.
Gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards.
All right. Today is Sunday, the 3rd of March. This is a recap for the stock market activities last week and an outlook for the week to come. It's also a macro commentary, you know the deal. But folks, I got a good one for you tonight. We're coming to you live from the windy city of Las Vegas. Oof, it was a rough night last night. And now they're making a remake of this movie Twister. Is there anything sacred anymore? Or did we just tap out as humanity? Maybe it is time for AI to nuke us already. But the wind gust in the city of Las Vegas reached 70 miles per hour. I know what you're gonna say, but Maverick Dad, that's nothing. I live in Florida. We got hurricanes here. Yeah, that's why I don't live in Florida. But if you thought it was bad in Vegas, check out what happened in Northern California. 190 miles per hour near Tahoe. And I believe that the record in California is 199 miles per hour. So we got really close. But the weather aside, I wanted to produce this show on Saturday, last night. But then I realized that 99% of the male population in America was busy watching Saturday Night Live. I'm not sure why. It's lame. Stupid show. But maybe it's because 99% of the male population in America want to see a place where shrinkflation doesn't exist. Let's see how the Federal Reserve can tackle this kind of inflation. Speaking of, you know, the terminology when we talk about cancer, God forbid, hopefully nobody will get it, but chances are some of you will. That's the bad news. There's nothing I can do about it. All you can hope is maybe AI will figure it out, because it's a 16 trillion gazillion valuation right now. Maybe AI will figure it out. But there are stages of cancer. You get the disease, you feel bad, you go to the hospital, the doctor gives you chemo or treatment of some sort. And then you have something called remission. The cancer is mostly gone. You feel good, you feel better. And then what happens? There's something called recurrence, or those cells that never got tackled by chemo or by the treatment, the surgery. They come back and grow cancer in your body again. And that's called recurrence. This is exactly what we see in the economy and financial markets right now. So without further ado, here it is. In focus tonight. Recurrence. It's back, baby. And now it's up to the Federal Reserve. Mr. Powell, what are you going to do about this? You see, last year, we got a stock market comeback, mostly led by the 7 stock dubbed as the Magnificent 7, the largest technology companies in the world. Of course, now a few of them fell apart, so we call them the Fantastic Four, and soon enough we're going to call them the Three Stooges. But 23 was a battle between the narrative, the bulls versus the bears. The bears would accuse the bulls of, hey, you're jerking off to a market that's not really healthy, because the breadth is not good. You only have 7 stocks moving higher. The bulls will counter and say, who cares? Best stocks in the world, most profitable stocks in the world, and now they're cutting costs. If they single-handedly lift the stock market higher, so be it. But breadth will come back. Breadth will improve, even though the bears said that breadth usually is the marker of a beginning of a bull market. Usually we see small caps leading the recovery from bear to bull. Well, now, finally, we're getting participation besides the Mag 7, now the Fantastic Four, but not the kind of participation that anybody was really hoping for. This kind of participation is broadening of the bubble and the mania, where we see the riskiest assets beginning to catch a bid again, where we see speculation running rampant in the market again. When you see stocks surging by 20-30% in a day, and also, in other cases, dropping down by 20-30% in a day. But we go back to 23. The argument was, okay, if this is a risk-on rally, then how come cryptos and Bitcoin are not participating? Now, we got the participation of Bitcoin and cryptos, and then some. A marker that the bubble is broadening, getting more dangerous, and speculation is coming back, retail participation coming back. Most importantly, we're now realizing that you can't have your cake and eat it too. If you're going to induce a stock market bubble, you see asset price appreciation. Even in the risk-on assets, we see comebacks. You really thought that's going to happen without the comeback of inflation? And now it's becoming clear that we haven't finished the course that the Federal Reserve began to eliminate cancer from the body of the economy and from the body of financial markets. It seems that the Fed declared victory prematurely, and now we see the cancer coming back. It's a different perspective. A lot of folks listening to me right now would be baffled. Wait a minute here. You're supposed to be happy, Maverick. This is the beginning of a new bull market. You're seeing assets appreciating again. We're so back. I look at it as the return of cancer, and it has to be addressed. And by addressed, I mean an aggressive return of treatment. But the difference between now and back in 21-22, when the Fed was doing chemo to the economy and the stock market, we could handle it back then. Now there is so much damage that we can't really handle it. More on that in a minute, but the talk of the town this week was Bitcoin. We have seen a huge comeback in the price of Bitcoin. With it, of course, comes the speculation and the outlandish price targets. The headline reads, Bitcoin is hurling toward its record high of 69,000. Experts see 200,000 in sight. And the experts here are Mama Kathy Wood and Shamath and Drunk Michael Saylor and Scumbag Amushi, the typical characters. They're now coming back. And by the way, the comeback of cryptos, your favorite YouTubers will be really happy because now we get the crypto scammers back. That helps with the exposure and the comments. Crypto spending in advertising, that's going to come back. So don't be surprised to see your favorite YouTubers now pumping more and more videos. But what's really peculiar about the comeback of Bitcoin, see, the price reached 69,000, then Bitcoin crashed to sub 20,000. In that journey, though, there was no participation by the big guys. The big guys did not own a piece of Bitcoin. Now they do. And the biggest one is BlackRock. And the BlackRock Bitcoin ETF hit record volume, a single day high, $612 million pouring into the BlackRock ETF. So nobody liked Bitcoin at 20,000, 30,000, 40,000, 50,000 besides BlackRock. Now that we're at 60,000 plus, The retail crowd, of course, is chasing Bitcoin again. What do you think BlackRock is going to do here? But it's not just Bitcoin. If it was just Bitcoin or Ethereum, we would have said, okay, maybe these assets are coming back, they have some value, they have some demand by BlackRock, and the ETFs got it. But the sign that this is just another speculative frenzy is look at what's going on with FTX. Yep, that's the same FTX by Sam Bankrupt-Fraud. That was up 20% in a single day. Cumrocket is up over 500% in less than 5 days. And now we got to prepare for Titcoin, Shitcoin, Dickcoin. And the speculative frenzy comes back. There's talk that GameStop might come back. AMC, which we gave it a shot this week, didn't work out. But maybe next week we'll give it another shot. You see the crypto scammers coming back. They hacked the account of Mohamed El-Arian. He was pumping a lot of crypto and tulip advertising. Folks were baffled. Wait a minute, Mohamed El-Arian is now a proponent of cryptos? Well, it turns out the guy got hacked. But folks, there is a day that you got to keep in mind, and this day is March 29th. Why? Because we see massive, and I mean massive, amount of calls and put options being bought in Bitcoin for that particular day. So what's up with this trade? What's going on here? And by the way, in the options market coverage, you'll see that somebody sold $80 million worth of QQQ calls deep in the money. So there's something happening here that's really weird. But one step at a time. Headline reads, Bitcoin on verge of violent move after surge toward record, options show. What are they talking about? Here it is. An influx of buyers for short-dated options has increased Bitcoin volatility to the highest since last year's collapse of crypto-friendly Silicon Valley Bank. The notional value of the March 29 calls and put options contracts has climbed to around $7 billion. Wow. Far above the amount of any other contract on a specific expiration date. The jump in short-term options that have strike prices in a relatively small range is laying the groundwork for what's called a gamma squeeze, in which a change in price can trigger a rapid swing in the market. The open interest for the contracts with the March 29th expiration date is clustered at 65,000, 60,000, and 70,000, a short distance from the current spot market price. Now, why is this important? They'll explain the gamma squeeze in a minute, which is if these prices are surpassed, the market maker will have to buy. And that could surge Bitcoin to 100,000 and beyond. But if these traders decide to close their trades at 60,000, 65,000, or 70,000, and they keep the puts, then we could see the other phenomenon called inverse gamma squeeze. Here it is. They explain the gamma squeeze for you. If a large amount of call options are bought, the sellers of options, usually dealers or market makers, need to hedge their exposure. The usual way to hedge is to buy the underlying instrument so that they're not exposed to directional risk. If Bitcoin starts going up, the dealers will have to hedge further, thus buying more of the underlying token. The self-perpetuating loop can lead to a rapid price increase as dealers push the price up, causing them to have to buy more. So they explained the gamma squeeze, not quite the inverse gamma. The bottom line is it's going to be an incredible couple of weeks for cryptos, but specifically for Bitcoin. If it goes the way of the gamma squeeze, you probably hear Bitcoin 70,000, maybe beyond. But if it goes the other way, the inverse gamma, and this is why the whales control a lot of this stuff, we could see what JP Morgan is warning about. Why Bitcoin could fall 33% after its long-awaited halving event in April, JP Morgan said. What are they talking about? Here it is. JP Morgan sees the aftermath of this presenting downside risk for Bitcoin, which recently surged above 60,000 for the first time in more than 2 years. The firm notes that while production costs have put a floor under the price of Bitcoin in the past, the boundary could be pushed lower after the halving. Of course, the positioning usually happens before April, before the event takes place. So once the dust settles after the halving, JP Morgan says Bitcoin could fall as far as 42,000 or 33% from the 62,608 level where it was trading on Friday. The Bitcoin network's hash rate is the focal point of this forecast. JP Morgan says it could fall 20% immediately after the halving, quote, mainly due to less efficient rigs existing mining as they become unprofitable, end quote. Why is this important, folks? Now, look, I think the moves will happen before the halving event in April, so March will be an important month for Bitcoin, and specifically March 29th. This is where traders are positioned for the move to happen before April. But the risk here is these miners. A lot of you are investing in these miners, Bitcoin miners, crypto miners. As we see the proliferation of ETFs, be it Bitcoin or Ethereum ETFs, these miners will become less and less relevant and less profitable. So you have to think about your exposure to cryptos and Bitcoin at this point. In the last few months, it was okay to buy anything with a relationship or exposure to Bitcoin. Now you have to be more picky. Of course, you got the ETF by BlackRock, you got Bito, all of these ETFs are going to track the spot price of Bitcoin. Then you have other kind of exposures, like MicroStrategy, for example, aka MicroTrageedy. This is as pure as exposure to Bitcoin you can find because they have actual physical Bitcoin. Then you have the exchanges such as Coinbase, and by the way, the CEO dumped about $60 million worth of shares. Those are going to be less and less relevant. They're not going to track Bitcoin price as much as they did in the last, let's say, couple of months. Then you have the highest risk, which is the miners. And you see, at least in the last couple of days, Bitcoin pretty much at the highs, Coinbase at the highs, MicroTrageedy at the highs. But then you have a miner like Marathon Digital Holdings, I believe, and you got Riot. These stocks went down a little bit and they could not really track and trade at the highs as Bitcoin did. So the miners at the most risk here. Regardless of all of that, folks, the surge in Bitcoin is just a symptom of the problem that we have in the markets right now. The Federal Reserve did not finish the job in ridding the economy out of inflation. The Fed was playing these mind games of, oh, we want to tackle inflation but also keep the stock market higher. For now, they succeeded and they declared victory. But now they're realizing that they can't have their cake and eat it too. That the wealth effect is important in tackling inflation. And if you keep the wealth effect higher, inflation will come back in no time. And the rise of Bitcoin is again a symptom of the problem that we have in financial markets right now, which is bubbles showing up all over the place. Dangerous bubbles, and collectively the most dangerous bubble of all time because of the sheer weight of these bubbles. These individual stocks in these bubbles, if they go down, they're going to take everything down with them. And you see headlines like this from CNN. NASDAQ and S&P 500 soar to record highs as markets appear unsinkable. Someday we're going to look back at this headline and realize that we're actually on board of the Titanic. But here's the problem, folks. You might say, look, Maverick, all of these bubbles are distractions. I'm a fundamental kind of investor. I look at earnings, I look at growth, and I follow. Good valuations. How is that going to affect me? If these bubbles blow up, who cares? I'm not exposed. The problem is you will, whether you like it or not. I want to explain this to you by reading this article about Tony Robbins, big fan of the show, by the way. It says that he shares one reminder for those caught up in the Magnificent Seven bubble, and they're no longer the Magnificent Seven. Just like the movie, few of them die. Now they call them the Fantastic Four. Then one is going to die and they become the Three Stooges, and then whoops, everybody died. But here's what Tony Robbins says to those caught in the still inflating Magnificent Seven tech stock bubble. It is a worthy endeavor to remember that there are 493 other potential equities to invest in within the S&P 500. Industrials, healthcare, and more are there for picking. And outside of the S&P 500, there could be great investing opportunities in private equity, treasuries, and hey, and maybe even classic cars, if that's your thing. Tony, have you been in the streets recently? Do you see how average Americans live? You're talking about classic cars and paintings, if that's your thing? Not all of us are millionaires. Most Americans are living paycheck to paycheck. But when we talk about a bubble, folks, it's not just the financial markets bubble. It's the bubble that the elite lives in, the bubble that Wall Street lives in. So I was listening to CNBC on Friday, and there was an analyst who comes in halftime, good guy. But he comes out and he says, well, everything's fine with the economy. I mean, the valuation of your homes, folks own homes, and the value of your home went higher. And I'm like, what kind of planet does he live in? Not everybody's a homeowner, specifically if you go down the generations. The millennials, Gen Zers, forget about it. They can't even dream about the American dream. And by the way, how is that a good thing? If I'm sitting on my home and the value went higher, okay, can I get out of the home? If I get out, that's another problem. I got to find another home, which will cost me also inflationary prices. So it evens out. Oh, by the way, home insurance rates are skyrocketing right now. Sure, I can take a loan on the equity price, but that's still debt. So how is the increase of home prices that we're sitting in right now is really helping? I'd rather see the market opening up and prices going down to become attractive again. But back to Tony Robbins. Known for his ultra-high energy seminars, Robbins, who has a reported net worth of more than $600 million. It's a big number. Maybe that's why he lives on another planet. Warned against the AI hype bubble. I'm concerned about it as well, Robbins said, about investors' infatuation with the Magnificent Seven names such as Nvidia and Microsoft. So whether you're listening to Tony Robbins or even value investors, all of a sudden bargain hunters are showing up in the market, buying these value stocks. Okay, the AI bubble, dangerous, got it. will stay away. But what about value stocks? You can still invest in value. And if the AI hype goes down, who cares? It's not going to impact me. My rebuttal is, it doesn't really matter. Unfortunately, this time around, we have to time the market. We have no other choice. Because the sheer weight of these names, when they go down, not if, when they go down, because of the ETFization impact of the market, the stupid passive investing bubble, they will take everything down with them, even good stocks, even value stocks, even whatever stocks. They're all going to go down. Good news is, if you like them now, you like them even more when they get cheaper. Strategy, do what I'm doing. You buy stocks, they run way too high, 15, 20, 25%, you trim them, you take them off. You park the money in a money market fund. Now you're earning 5% plus. If there is another opportunity that comes out, such as when I saw the Ozempic mania sell off in names like McDonald's and the medical devices and the food stocks, okay, you get back in and you buy these dips in these stocks. Make another 10, 15%, take the money out, park it in a money market fund. And the ultimate buying happens after the crash, because these names will take everything down with them. We talk about these names, folks. It's not just the AI bubble. We have three main bubbles that we see in the market right now. We have the construction bubble, names such as Martin Marietta, Train Technologies, Grainger, Eaton, and many more. Then we got the Ozempic bubble, Eli Lilly and Novo Nordisk. Those are the two main ones, Ozempic and Mounjaro. Then we have the AI bubble, mainly NVIDIA. Then we have other names like Microsoft, AMD, ASML, and many more. Let's talk about them one by one. How it started. The construction bubble, easy. The insane fiscal spending by the Biden administration. Now, we can argue about the need of infrastructure and spending, got it, but it doesn't seem that we're even negotiating good pricing with these companies. So when the Biden administration has a project and they buy tools from Grainger, price could be $80,000, but Grainger will charge $300,000. Nobody in the government will challenge any of that. So we see the pricing power in these names surging higher. And of course, there's a lot of corruption in these projects. A lot of politicians get greased, a lot of businesses get greased, and money get lost in the middle, courtesy of the taxpayer and the issuance of bonds, because this is money that we don't really have. We can't raise taxes, so we have to borrow the money from other countries. And this is why we keep issuing more and more bonds. Then we have the Ozempic bubble. You got to remember that Ozempic has been a drug for many, many years, but it became mainstream when celebrities came out and said, we're losing weight, a lot of weight, the easy way, using this Ozempic. Off-label, of course. All of a sudden now we have a mania and a huge surge in demand for Ozempic, Mounjaro, and any of these products. The AI bubble, how did that begin? When we got the news that Microsoft is investing in OpenAI. Now, OpenAI was a company and ChatGPT was a product available in 22. Nobody gave a shit about it. But the moment Microsoft began investing in AI, it started a race and a mania, which we now know as the AI bubble. Okay, what is the status of these bubbles right now? The construction bubble, the easiest one, I would say it is maturing. And this is why, at least my end, I sold the majority of my exposure in this bubble. Now, why do I say maturing? Of course, the unsustainable fiscal spending, that has to come under control. And we see the threat of government shutdowns. The spending will be cut sooner than later. But we also got bad data this week. Construction spending falls for the first time since December 22. That's not a good sign for these companies. Then we'll look at the status of Eli Lilly, Novo Nordisk, the Ozempic bubble. That's becoming more speculative. What do we mean by that? Okay, Eli Lilly and Novo now trading at the moon. The prices of these stocks are way too high for anybody to participate, really. And the risk of these stocks going down is really high. So nobody wants to buy them at this point. So we see folks speculating. What is the next Ozempic? What is the next company that's going to come out with a weight loss drug? So we see even the big pharma names, Merck, AbbVie, Amgen. Those stocks have been moving higher. Amgen, of course, got a correction recently, but they're buying the dip out of speculation that, a drug will come out of Merck, or AbbVie, or Amgen, or other names. We see even speculative, smaller companies like Viking Therapeutics. The stock price of this company more than doubled this week alone, because they got a trial where their drug shows similar effects with Ozempic. We have another avenue for speculation, which is the XBI biotech. Now we see speculators saying, okay, what is the next small biotech company that will be bought by a larger big pharma company? What is the next biotech company that will show results on weight loss drugs? And we see speculation coming in the XBI and biotech. And by the way, these kind of bubbles, the biotech bubbles, they usually happen at the end of a bubble episode. Go back to 2000 when we saw the biotech bubble. It didn't last for too long. It was right at the end of the dot-com bubble. In any case, what about the status of the AI bubble? I would say it is broadening, and hear me out in this one. When it began, it was Microsoft mainly, but big cap technology stocks with a lot of cash such as Meta, Alphabet, Amazon, Oracle, buying the existing inventory of AI chips by NVIDIA. Now, NVIDIA sees this massive surge of demand, and a reminder, these chips were available in 22. These chips were available before the fourth quarter of 22. Nobody wanted them, but all of a sudden Microsoft begins the race, and we see a huge stampede by these companies. All of a sudden NVIDIA says, whoops, supply is short, demand is high, we gotta jack up these prices, baby. And it goes to 40,000 a pop. All of a sudden NVIDIA becomes the hottest stock in town, because now they can expand their margins based on the pricing power. But soon enough, the inventory is gonna run out, and already did, so they have to manufacture more to meet the demand. All of a sudden now NVIDIA pays Taiwan Semi. That stock joins the bubble and becomes hot. Well, Taiwan needs to keep up with all of this demand. They need more equipment. Well, they have to buy the equipment from names such as ASML, Lam Research, Applied Materials. These names become hot too. And then NVIDIA needs to solidify its gains in AI, so they buy stuff from ARM, they buy stakes in SoundHound, in Recursion, biotech company, and of course now Micron is manufacturing the memory for the new generation AI chips by NVIDIA. So Micron now catches a bid too. Now we go back to the big caps, large technology companies. They can't just buy the chips and do nothing with that. They have to invest more to reach their AI ambitions. So all of a sudden they're buying stuff, servers from Dell and Supermicro. So you see Supermicro Computer, the stock been rocketing, and now it joined the S&P, which adds back to Tony Robbins now. It doesn't matter, Tony, because you have Supermicro in the S&P. If that name goes down crashing, with all of these names that you see right here, those who are in the S&P, they will take down the index crashing, and it doesn't matter what you own because the ETF will be sold. But you see this week Dell, for example, surging higher over 30% in a single day because the companies are buying servers from Dell. So we see the bubble now broadening. And as the bubble broadens, investors are looking for the next company. What is the next one that will be involved in this bubble? And it's already been fluffed up in valuations before they show any results. Example, AMD. The stock more than doubled in value in about 3 months or so, but their earnings were not really that good. Their guidance was not even that good, even though we bought AMD in this channel and the theory was AMD will eat some market share away from NVIDIA. Maybe that's going to happen at some point, but I think that AMD will be the needle that would pop some of these bubbles in this larger AI bubble. For example, if AMD takes away market share from NVIDIA, then that's going to hurt NVIDIA. So in looking at the AI bubble and your participation in it, which names happen to be the strongest ones? Because if AMD takes away market share from NVIDIA, that weakens NVIDIA. Do you want to be in the big caps or spending on steroids right now and probably their margins will go down? Not really. Are you really good at speculation? You can figure out which is the next company that NVIDIA is going to invest in or the next company that will offer servers to these mega cap technology stocks. Maybe you're good at that, but I see the manufacturing side. Taiwan, ASML, Lam, Applied Materials. I see these companies as the strongest ones in this bubble because it doesn't matter which designer it is, NVIDIA or AMD, or whose buyer it is, Meta or Microsoft, doesn't matter. They get an order, they manufacture, they take the money. Now understand that we have a lot of risks with these companies. For example, this week we got bad news about Applied Materials. They've been selling indirectly, of course, equipment that the US government doesn't want to be sold to China. So that could be a problem, but that leads us to how it ends. I think when it comes to the construction bubble, the elections will be the end of it. Be it the Biden administration or the Trump administration, doesn't matter. They have to get spending under control. It is unsustainable. Maybe the Biden administration is spending right now, but once they win the elections, there is no need for spending and stimulating jobs and the economy anymore. If the Republicans win, there will be a lot of pressure to follow a tighter fiscal policy and reduce the debt and the deficit. When it comes to the Ozempic bubble, that's really tricky. You can't really pinpoint which one is going to pop the bubble. It could be the patent risk, generics, side effects becoming more and more known to the public, social pressure. You're going to hear more of this, that Ozempic is the drug of the rich, and now they're putting teenage health at risk because of these unrealistic expectations of weight loss and unaffordability of the drug, yada, yada, yada. Now, the tailwinds are still strong. Ozempic and Mounjaro, hundreds of other drugs will become more expensive in 24. That's inflationary, by the way. And folks who are using Ozempic right now in a budget, well, that's going to take away from their spending elsewhere. They have to tighten the belt, literally, to stay on this drug. It's $1,500 a pop if you can find it to begin with. Analysts, of course, saying that Eli Lilly is going to still surge 29% over the next year. They're going to make $60 billion in sales, yada, yada, yada. But folks, With these bubbles, it's the same thing. We see a surge of demand, for whatever reason it is, in the AI mania, Microsoft initiating the race, in the Ozempic mania, celebrities and weight loss, easy weight loss. You don't have to go to the gym, you don't have to even diet. But we see a huge skyrocketing demand. Supply is nowhere to be found, prices go higher, the margins of these companies improve dramatically. We create a bubble. Sooner than later, supply comes in line, and we see prices coming down, and the bubble pops. The other risk with these drugs is competitors, generics. We already see folks going to the black market, going to shady websites to buy Ozempic online, and the FDA is now warning you gotta be careful where you buy it from. You gotta make sure that you pay Eli Lilly, you gotta make sure that you pay Novo Nordisk, because they pay us. The FDA is owned and controlled by the big pharmaceutical companies. The job of the FDA is to keep the monopoly of these pharmaceutical companies. It is a revolving door. The previous FDA commissioner is now working for Pfizer. But again, the problem is similar, and the solution is similar to every bubble. Huge surge in demand, pricing power goes to the moon, companies making record profits, or whoever the seller of that product that is in demand right now, making huge profits. That's going to attract the eye of competitors, alternatives. In the case of Ozempic, we see generics, we see compounding pharmacies, we see folks going to Mexico to buy cheaper Ozempic, and now the cartel is about to get into Ozempic too. I mean, you sell coke or heroin, fentanyl, that kills your customer at the end of the day. What is the point? But you sell your customer Ozempic, now they're hooked for life, and you keep getting that revenue. So even the cartel is now getting into Ozempic. When it comes to generics, we know that the patent for the US, at least for Ozempic, lasts all the way to 2031. But that could also be under review. We got the news that the US Patent Office will review the Wegovy and Ozempic patent for Novo Nordisk. Now, I'm not hopeful that they're going to change their opinion or change the patent, because the judges are also owned by these pharmaceutical companies. The risk comes in China. So the patent in China expires in 26, but the Chinese court is now reviewing whether the patent is valid or invalid. And of course, Chinese companies want to get into it. Once they figure it out and the patent is gone, we see generics showing up, supply increases, prices go down. Every bubble is resolved the same way, at least from a fundamental standpoint. The speculative side, that's up to the Fed, that's up to weird reasons to pop that speculative part of the bubble. But the fundamental side can always be resolved by the increase of supply. So we go to the AI bubble. How will it end? Cost pressure. So you have a lot of names. Now Microsoft will spend more. Apple will have to spend more. Even NVIDIA will have to spend more. And as the spending increases, the margins begin to normalize. The margins begin to even go down for certain names. The entry of competitors and loss of pricing power, that's also a way we can pop bubbles in the technology sector. NVIDIA is not the only one that can design and manufacture AI chips. We have AMD, we have Microsoft now manufacturing their own chips, Amazon, so on and so forth. And of course, once a recession happens, companies can't spend anymore. They have to tighten the belt and tighten the budget, and we see the end of these bubbles. Bottom line is, these are not small companies we're talking about. These are not IPOs. These are huge companies with multi-trillion dollars in value. If they go down, they take down the entirety of the economy and the stock market with them. So you're not going to have anywhere to hide, really. Even if you're a stock picker and you're hiding in value or healthcare or real estate or whatever sector you think it's safe, the sheer weighting of these companies coming down will take everything down with them. Nobody's paying attention now. Everybody's amidst the euphoria and the mania, but nobody's asking questions. What happens when these bubbles pop? These companies are now too big to fail. We cannot take their valuations down. If these valuations come down rapidly, not only these companies and the investors will get hurt, but the retirees, the sentiment in the economy all in all, the unemployment rate will go higher. And that leads us to the macro part of our coverage. Now, your question might be, hey, Maverick, if we have all of these bubbles going on, then does it really make sense for the Fed to cut rates at this point? Absolutely not. That's the easy part. The hard part is, does it make sense for the Fed to raise rates? Because all of this is cancer coming back. Soon enough, as you've seen in the intro, we will see inflation coming back. You'll see the data in a minute. Soon enough, we'll see oil going higher again, commodities making a comeback, goods inflation making a comeback. And if the Fed raises rates at this point, you got to understand that we already have a lot of damage from the previous round of chemo that the Fed has done in the year 22 all the way to 23. And that's going to be a disastrous outcome for the economy. And this is why we need rational policy, not pursuing a fantasy. Pursuing a fantasy is what's going to end all of this in a tragedy. And of course, your media is absolutely delusional. I mean, listen to this headline from CNN. It reads, the U.S. economy is so strong that there might be not any rate cuts in 24. Really? Is the economy really strong? Let's look at the details and the facts. We begin with the inflation reality. So we got the CPI, the PPI, all of them beating expectations in the month of January. Everybody said, wait, the Fed looks at the PCE report because it manipulates the data and it has the tendency of downplaying the true nature of inflation. Okay, now we got the PCE and the headline reading year on year, it's below 3%. That's good news, right? Here's the problem. If we look at the month-on-month readings, those are going higher, significantly so, to the highs of 2020 and 21. That's your leading indicator. The PCE inflation will go back above 3 again soon enough. If the Fed doesn't do anything, above 3.5, then 4, and inflation makes a comeback just like it did in the 70s. It's cancer. You gotta kill it. You gotta be aggressive. You gotta suffer the consequences and have a strong stomach. Otherwise, it will come back. Look at the super core inflation in the PCE report, month on month. I mean, look at that reading. Look at that massive column that we got. That's going to show up in the year-on-year reading and the month-on-month reading in next reports. So you see the contrast. If you look at the year-on-year PCE inflation in black, oh, it's going down. But then you look at the month-on-month, the 1 month trimmed mean PCE. Look at that massive pop higher, above 4%, almost 5% in the PCE report. And the majority of this increase in the PCE, CPI, PPE, any inflation metric you want to look at is coming from services. Why are we seeing this phenomenon? The Federal Reserve pursues a fantasy called soft landing, Goldilocks. They say, oh yeah, wages going higher, no problem. Financial conditions loosening, no problem. Secretly, the Federal Reserve never gave up the transitory theory that inflation is going to go down and the economy will be fine, unemployment will be fine, wages will go higher, stock prices will go higher, home prices will go higher, and everybody's going to live happily ever after. Well, if wages are going higher in the service sector of the economy, that's going to begin to show up as services inflation. Companies pass the input cost to the end consumer. With what's going on in the Red Sea right now and the increase in commodities prices, you'll begin to see the comeback of goods inflation, and then it's too late. The Fed will have to be aggressive and shock the economy. Even regime propagandist Jason Furman, who's a big fan of the show, by the way, that's why we like to tease him here, but he also admits that core CPI inflation picked up a lot in January, annual rates. So when you look at the 12-month, 2.2%, okay, that's good. We're getting back to the inflation target of the Fed. Look at the 1 month, 5.1%. He adds that not a surprise relative to what we thought yesterday, but high relative to what might have been hoped a month ago. I say amen. You look at the housing market, Fitch says that 91% of homes are still overvalued. Housing inflation, according to the Case-Shiller, reached all-time highs. Average home insurance spiked by as much as 60% in many states this year alone. That's the inflation side. It's coming back. There is no doubt about it, and we knew that ahead of time in this channel that you can't have your cake and eat it too. You want higher wages, you want higher equity valuations, you want manias and bubbles and higher home prices, you're gonna bring back inflation. The problem is now, from the Federal Reserve standpoint, you can't be really as aggressive as you could have back in 21 and 22. Why? Because we see damage in the economy already. We see recession showing up in many corners of this economy, combined with the comeback of inflation. It's a phenomenon we call stagflation. Just here are some of the economic data that we got this week. U.S. pending home sales fall by the most since August. Chicago Business Barometer unexpectedly dips to the lowest level since July. Construction spending falls for the first time since December 22. Jobless claims jumped more than expected last week. Continuing jobless claims jumped to the highest level since November. U.S. consumer confidence soured in February for the first time in 3 months. The survey's index fell in February to 106.7, down from a rating of 110.9 in January. Americans become less worried about rising food and gas prices, but more concerned about the jobs market, the survey showed. You look at the manufacturing PMI that we got this week. The headline reading is down 1.3 points. The direction is contracting and the rate of change is faster. New orders down 3.3 points. The direction is contracting, rate of change from growing. Employment down 1.2 points. Direction contracting, rate of change faster. Now you look at pricing, down 0.4%. The direction increasing, rate of change slower. So prices going higher, be it at a slower pace, but the fundamentals of the economy in manufacturing not doing so hot so. Now we're beginning to see the stagflation problem. And in stagflation, raising rates will produce severe damage to the economy. But if these bubbles get out of hand, the Federal Reserve will have no other choice but to tackle them down by a rate hike, and that will be devastating for the economy. Headline reads, Americans' cost of living remains a massive headache, even as recession fears fade. This is from CNN, so obviously it's a false headline. Recession fears are not fading, I just showed you. But that's your beloved media. Another headline reads, Millennials and Gen Z face snowballing debt as high card balances and interest rates eat into their credit scores. And that's going to get worse, folks. Rates might not even come down. They might go higher from this point on. At the same time, you have the comeback of inflation. So if you got some relief from inflation in the last few months, prepare for the comeback. This is stagflation, this is reality, and it is painful. What the Federal Reserve has accomplished from its pursuit of the fantasy of soft landing is now the 1% of this country owns more wealth than the entire middle class. Never happened in history before, but thank you to the Federal Reserve. Now it is a reality. We always said that the mission of the Federal Reserve is not to serve the public. It is to serve the oligarchy, and they're doing a pretty good job. Now, the other problem with these bubbles forcing the Federal Reserve to stay tight or even raising rates further, have we forgotten about the problem that we have in banking, specifically regional banks and the exposure to commercial real estate? Just this week, we've seen shares of New York Community Bank collapsing again. This time around, we find about shady dealings and accounting by the CEO, CFO. They're all put on leave all of a sudden. And the incoming CEO says, while we faced recent challenges, we are confident in the direction of our bank and our ability to deliver to our customers, employees, and shareholders in the long term. The changes we're making to our board and leadership team are reflective of a new chapter that is underway, says the captain of the Titanic. Now you might say, but these problems are just idiosyncratic to New York Community Bank. Didn't you say that about Silicon Valley Bank? By the way, we're hitting the window now of the lending facility by the Fed. Are they going to extend that, or will the bank be on the hook to pay the Fed back? It's not really an idiosyncratic problem, folks. Listen to this headline. Wall Street is worried about New York Community Bank's loan losses and deposit levels as the stock sinks. So it's not just a management or corruption deal alone. They're losing a lot of loans. Deposits are fleeing, despite the fact that the management comes out and says, oh, deposits are ample. Bullshit. Now some are questioning the stability of New York Community Bank deposits amid the tumult. Last month, the bank said it had $83 billion in deposits as of February 5th, a slight increase from year-end. Most of these deposits were insured, and it had ample resources to tap if the uninsured deposits left the bank, it said. And the sources trust us, bro. New York Community Bank has not provided an update on deposits, which we can only infer they are down, says D.A. Davidson analyst Peter Winter. The company has strong liquidity and solid deposit base, and I'm confident we will execute on our turnaround plan, says the captain of the Titanic. The pressure on New York Community Bank's operation and profitability amid elevated interest rates and a murky outlook for loan defaults has raised questions as whether New York Community Bank, a serial acquirer of banks until recently, will be forced to sell itself to a more stable partner. And the only one is JP Morgan, the only bank that can actually absorb these banks. But JP Morgan said no more. These are liabilities, not assets. We don't want them anymore. But of course, you have Janet Yellen, who's now doing everything she can to keep this zombie economy on life support by forcing JP Morgan to buy these shitty banks and then throwing in favors to JP Morgan. So wouldn't be surprised to see another episode of that. In conclusion, folks, the rise in Bitcoin that we've seen recently and other speculative assets within cryptos and stocks is a symptom that this bubble is now becoming contagious and growing faster. And this is not a reason to be celebratory. This is a reason to be concerned, because this is cancer coming back in the body of the economy and the markets. It will require more aggressive action by the Fed, as we see inflation now showing signs of coming back. The problem is the Fed cannot really remedy the comeback of cancer with an aggressive round of chemo again and interest rate hikes, because there is significant damage to that body, these corners of that body. More hikes, more chemo will cause the death of these corners. We are now left in an unfortunate situation with stagflation in the economy, and we have to watch these bubbles going out of whack until they explode in their own, unless the Fed has the stomach and the will to pop them by raising rates at this point. With that, folks, let's move on to add more color and cover the stock market by looking at the closing of the indices last Friday, and here we go. The diamonds in the green by 90.99 points, or a gain of 0.23%. The Nasdaq leading the pack with gains of 183.02 points, or a gain of 1.14%. The Spider also in the green by 40.81 points, or a gain of 0.80%, while the Russell 2000 for small caps up by 2.16 points, or a gain of 1.06%. The sectors on Friday were led by technology, followed by energy, then healthcare. Most sectors were in the green as we've seen managers positioning for the month of March, and they decided to go with what's been working, chasing the same bubbles over and over and over again. The only laggard is utilities, down fractionally. For the week, technology is still on top, followed by cyclicals, and then real estate. We've seen bond yields dipping down a bit, so that was good for real estate, good for some financials. The dollar also cooled off a bit, so materials did pretty good. But the laggards, led by comm services, aka Google, that's one of the magnificent seven that is going down right now. When we look at the breadth on Friday, despite the fact that it was a big rally in the Nasdaq, the breadth was not really that good. It was neutral. The NYSE was 63% advancing versus 35% declining. The Nasdaq, 55% advancing versus 41% declining. And the reason is, majority of the gains came from the same bubbles, same technology names. When we look at commodities, here's perhaps where the Fed should be paying attention now. The closing of Friday saw gains for the WTI worth about 2%. Likewise, Brent closed with gains almost of 2%. Heating oil, aka diesel, with gains of almost 2%. Gasoline RBOB, what you and I pay in the pump, up about 1%. And then we have natural gas with a pullback of about 1.25%. Metals making a comeback. The dollar was soft by about 0.25 percentage point on Friday. So we see a huge run in gold, silver, platinum. Copper was the laggard, but palladium was up a little over 1.5%. You look at the prices of meats. Live cattle, feeder cattle, all up a little over 1.5%, and then we have lean hogs also following the lead of live and feeder cattle with gains of more than 1.5%. Meats are still inflationary. Different picture in grains. Grains have been going down, but we've seen some signs of life, although not with a follow-up that makes them sustainable. So we see soybean meal green for Friday, while corn and wheat down. Wheat was down about 3%. It was up before, but again, no sustainability in these rebounds, and the reason is China is still weak. And that remains a drag on the grains market. Different picture in softs. Cocoa pulled back big midweek, but then made a comeback on Friday with gains north of 4%. Cotton, on the other hand, made a correction. It's been running really hot, but it made a correction on Friday, down about 4%. Good activities for OJ and coffee futures, but we see sugar down by more than 3%, and lumber futures closing at 600 with gains of almost 1.5%. For the week, all in all, believe it or not, natural gas, oversold rebound, gains of over 8%. But despite all of the gains that you've seen in the stock market, the Nasdaq, the Russell 2000, they were beaten by crude oil, WTI, and Brent gains north of 4.25% this week. Likewise, gasoline RBOB with gains north of 3.25%. So we see the comeback of energy inflation. That's going to bring the goods inflation back into the picture. And are we really prepared for that? I don't think so. Moving on to the big casino, the options market, what do we see here? The volume moved higher on Friday, no surprise. It's the beginning of the month, the end of the week, lots of activities by the end and the beginning at the same time. So we see volume going higher, but interestingly, the NVIDIA table is now hotter than the Tesla table for the first time in a long time. Calls are still outpacing puts in the ratios, so we see the bias still to the upside. Folks are buying calls in NVIDIA, Tesla, AMD, Apple, Meta platforms. While we see the flows showing a mixed picture, we see bullish flows into NEO, Meta, SPY, AI, Amgen, but bearish flows for the Qs, the IWM, the SPX, the cash index for the SPY, AMD, and NVIDIA, all with bearish flows. And some of these flows are really interesting. For example, look at this trade for the Qs. Somebody sold these deep in the money calls, 365 and 360, with the expiration date of March 15th, and they netted in credit about $80 million. Now, are they betting that the Qs will be trading below 360 by the expiration date of March 15th? Because that would be a crash, meaning that the Qs will erase the entirety of the gains since the November lows of last year. We also see weird bets on volatility for the month of March, so something is happening. You combine this with the options activities for Bitcoin, something is going to happen this month. Then you look at the SPX, a short call here, netting about $34 million in premium. Somebody selling the 5,000 calls for the expiration date of September 20. The implications are that the SPX will be trading below 5,000 by September 20. So maybe we are near a top right now. Keep an eye on these kind of flows because looking at the chart, you can see one picture, but there are folks positioning the other way underneath it all. Moving on to the unusual activities that took place in the options market on Friday, we begin with the ticker AMD. Now somebody's fading the rip here, and yours truly got out of the AMD position entirely. We'll give an update to the Maverick members in the portfolio review, but here's a trade against AMD. Somebody bought the 192.5 puts for the expiration date March 8, with expectations that AMD will go down and lose more than 5% of its value by the expiration date. They paid about $1.75 a piece to enter this trade, all in all spending about $2.3 million. Then we have a related bet here. If AMD goes down, maybe chips are due for a correction coming this week. So somebody bought calls on the SOXS. This is the 3-time inverse index for the chip index SOXS. So when chips go down, SOXS appreciates in value. And somebody's betting on that by buying the 3.5 calls for the expiration date March 8. The expectations, the SOXS will move higher and gain more than 5.5% by the expiration date. Paid about $10 a piece to enter this trade, all in all spending about $100,000. And it comes hand in hand again with a bearish bet against Nvidia. This time around, somebody bought the 765 puts for the expiration date March 15th. All short term, all betting for a correction in chips, implying that Nvidia will go down and lose more than 7% of its value by then. Paid about $5 a piece to enter this trade, all in all spending about $4.5 million. Let's move on to the heat map on Friday, and you can see that the managers, we were anticipating what are they going to do in the beginning of the month. And they're following what's been working. They're chasing the chips, the Nvidias, Taiwan, AMD, the manufacturers, ASML, AMAT. They're chasing some of the software names, such as Adobe, Oracle, CRM, not so much Palo Alto or the cybersecurity names like CrowdStrike. Those were in the red. Even in the big caps, what's really interesting, flows into Meta, a little bit into Amazon, Microsoft. We've seen outflows from Google and Apple. That's really interesting. Chasing of the Ozempic mania, Eli Lilly, NVO, those are moving higher. And again, whether they're speculating on Amgen or AbbVie or the XBI, the biotechnology sector, keep an eye on ISRG. That's another name that's getting really hot, and the managers love it and they love to chase it. What's really interesting is we've seen also they're picking up on the Chinese names a little bit. We see real estate in the green, but real estate went higher because bond yields dipped down. So not necessarily flows by the managers. We see flows in the energy sector. That's interesting. And we have flows in gold miners. We have a trade, a bullish trade on NEM, New Mount, and it's working out pretty good. We want to stick to that. If the name closes in the money, then we might consider adding some miners, but one step at a time, because you can't really guarantee what the dollar is going to do with the Federal Reserve coming back into the picture again. We contrast this with the weekly heat map. You can see how narrow the breadth is. The majority of the gains, once again, from the chips, semiconductors, some of the software names like CRM, Salesforce. Palo Alto was positive for the week. But again, Nancy Pelosi probably leading the sheep to the slaughter. She wants to fix her trade and then get out. We see the weakness again in Apple and Google, really notable. And then we see Berkshire Hathaway was down a little over 2.25%. We see that the insurance names were down for the week. Probably that's impacting Berkshire Hathaway. We see utilities in the red. We see outflows for some of the industrial names. We see staples, aka defensives, down, so there was a little bit of a rotation pre-Nvidia's earnings where the managers rotated back to staples and defensives. Nvidia's earnings come out and they rotate back to the chips. We've seen healthcare seeing outflows for the week, mainly impacting some of the big pharma names, but the insurance names led by United Health. Company has its own problems, but again, at some point, the Ozempic mania will hurt the insurers. Folks are now saying, oh, I got a heart condition, doc. Can you please write me Ozempic or Mounjaro? But really, wink, wink, I want to use it for weight loss, to look hot. Doctor goes with the program because they're getting a cut, and then the insurance will pay for your Ozempic or Mounjaro. But at some point, the insurance company is going to realize that, wait a minute here, we're paying too much. We're going to raise the premiums on everybody. And that's inflationary. We'll look at the heat map for the week for the ETFs. They've included the crypto ETFs. All of a sudden, all of them are up double digits for the week, so we're going to monitor that. But everything was positive this week. Whether we're talking about large cap growth, whether we're talking about value, mid caps, but small caps, these speculative names led the rise in the stock market this week. Mainly, of course, coming from the XBI biotech, as we're probably now seeing the birth of the biotech bubble, the biotech mania. And with the TLT up, meaning that bond yields down a bit for the week, we see some yield-sensitive ETFs making a comeback, like the IYR real estate, and we see the XHB home builders trading higher. Didn't need a comeback because it was already trading higher, unlike the IYR, which is real estate. Absent from the rate-sensitive rally is the KRE regional banks. The reason is we have a problem with New York Community Bank. International equities were muted. But of course, the Nikkei Japan EWJ remains the hottest component of international equities. You got to keep an eye on the yen, though, because the majority of the rally was due to the devaluation of the yen. And how the Federal Reserve reacts in devalues or increases the value of the dollar, that's going to have an impact on the yen and the Japanese stock market. Let's move on and do some charts and then wrap it up. We begin with the SPY, the S&P 500, an hourly chart. Right off the gate, my eyes go to the RSI, and we see that we have elevated RSIs, which means that probably the gains from here are limited. Now, a lot of folks say, why do you look at the hourly chart? Why not the 30? Why not the 15? The hourly is the golden standard. And this is really important. We talked about this to the members, but probably other viewers need to know that. Look at the MACD on the hourly chart. It was turning from bearish to bullish. And this is why in the note in the morning brief on Thursday, we said, be careful. You might see pullbacks intraday, but you don't want to get sucked into it. You want to buy the 5-10 calls instead on the SPY. When you zoom into the 5 minutes chart, look at what happened Thursday. We see a gap, somewhat of a crap. We close the gap and we go below the gap. And some folks and some traders might have been thrown off that, okay, this is probably a gap and crap, a reversal. I got to buy some puts on the SPY with the monthly expiration, with the April expiration. But had you kept an eye on the hourly chart, you would have known that you're not going to do that until you see damage on the hourly MACD. And that never really showed up, and therefore momentum dragged the market higher again. This is a lesson in using timelines. You always have to follow different timelines and not be stuck in one timeline, specifically a shorter time frame. When we look at the daily, since NVIDIA's earnings, we've been monitoring a formation of a bull flag, and it finally played out on Friday. When we look at the RSI, it's getting overbought, but not severely overbought. So it can do another pop higher if we see a gap tomorrow, combined with the hourly MACD on the SPY. Probably going to be a gap and crap. But again, that could be just a pullback, because unless we see damage on the daily chart, we don't have a reversal yet. And that would be losing the 20 days moving average. And since this rally began in late October, we have seen only 2 closings below the 20 days moving average with no confirmations. So we need to see a closing below the 20 and then a confirmation. Look at the weekly chart for the SPY. Steep, sure. Not corrected for a long time? Got it. Overheated in the RSI? Yes. But are we seeing a sign of a reversal? Look at the MACD, and last time we've seen a steep rally. The sign for a correction came when we've seen the MACD beginning to turn around. And we're not seeing that yet. So we need to see damage, the hourly chart. That's going to show in the daily chart. Then soon enough will show in the weekly chart. And then we're going to begin a serious correction process. And you see the gap between the chart right now and the 20 weeks moving average. It could be a sharp one, and it could happen this month. But we need to see a beginning signs of that correction showing up in the hourly, daily, then weekly. You look at the E-mini futures and hourly chart, what do we see here? We're back above 50, 92.5. And we got a little bit of a retest of that. So for now, you got to assume that unless we lose that line, the market wants to go higher. And even if we lose that line, we need to lose 50, 22.5 to move the advantage from bull to bear. Then we zoom out to the daily chart of the E-mini futures. Again, it's a bull flag pattern played out. We did not really lose the 20 days moving average, and the RSI still got room before it becomes really overbought. So unless we see a sign of a reversal, loss of the 20, confirmation of another day in the downside, we're not there yet. But it becomes more dangerous, of course. The higher we go with no corrections for as long as we went so far, increases the odds for a violent correction. We look at the Q's hourly charts, the same thing. Keep your eye on the MACD, because we've seen a flush in Thursday's session. We've seen a gap and crap, a retouch to the 435 support. It could have sucked a lot of traders into a trap. But if you kept an eye on the hourly MACD, we've never seen a sign of damage. So soon after a retest to 435, we've seen the Qs moving back up, and we've seen the MACD changing from bearish to bullish on the 1 hour. Now we see the opposite. Now we see the MACD curling back, looking for a correction of the recent move. We see the RSI really bloated and overbought. Would not be surprised to see a pullback, maybe a retest to 440.59. And then we have to look at the daily chart and see if we got damage. Look at the daily chart for the Qs, bull flag playing out. The RSI is not really overbought. Maybe we're expanding the boundaries of the Bollinger Bands a little too fast. We might see a correction on the 1 hour, but until something shows up in the daily chart, we don't have damage yet. You look at the weekly chart for the Qs. Look at the MACD once again. Are we seeing a look as we've seen in the summer of 23, when the MACD was curling down, showing peak momentum? Not there yet. We need to see damage in the hourly, then showing up in the daily, then the weekly, then we got a confirmation. These things could happen really, really fast, folks. And this month, it could be really interesting. We have a lot of events from the Fed and its policy toward banks and the monetary policy and interest rates, so it could be a really interesting month. Then we look at the NASDAQ futures, above trend. We only lost the trend once, and then came NVIDIA to the rescue, then formed a bull flag pattern, and now we're playing the bull flag pattern. We don't have any resistance that we can see. We have to form that resistance to find the numbers. But right now, trading above the highs, and the assumption in the daily chart, it goes higher until we see damage, and by damage we mean losing the trend line, losing the 20 days moving average, losing at least 17,735.75 to begin talking about, okay, this is reversing, this is already topped out. When we look at the IWM small caps, what do we see in the daily chart? Back at the highs from 23, but not really closing above the highs. We'll give the IWM the benefit of the doubt, specifically if the XBI/the biotech mania continues to heat up. That's going to lift the IWM higher. But we have resistance at the upper Bollinger Bands, and we have no damage in the chart until we lose the 20 days moving average at around 199.24. Now, folks, we'll bring out the divergence from the TLT. I got you. In the beginning, it was Supermicro. Now Supermicro is a part of the S&P, not the IWM. Then came the XBI, the biotech mania. You got to see biotech going down before we see the divergence between the IWM and the TLT closing up. Of course, the Fed policy becomes the most important thing to watch. When we talk about Fed policy, we have to look at the dollar, and the dollar so far, the 20 days moving average, as you can see in white, has been really tough resistance for the dollar. It needs a lift. It can't do it on its own. It needs a lift from the Federal Reserve. And this week we have Jerome Powell testimony in Congress. That could be important, and whatever he says, it could be the lift that the dollar needs to go higher. What about the downside for the dollar? The answer is it is limited because you have support of the lower Bollinger Bands. So you have to be worried about a move higher in the dollar, more than a move down. We look at the weekly chart for the Dixie, remains above the 20 weeks moving average. And this is why you gotta be careful. Looking at the time frames, maybe the daily is showing a little bit of weakness in the dollar, but the weekly is not showing that yet, indicating that the weakness that you see in the daily chart could be transitory. And then we see the dollar going back higher again. So when we look at the old man gold, we see a big pop on Friday, but again, it's getting outside of the Bollinger Bands, reaching the resistance at around 2080. I would find it hard to believe that gold will get outside of this range without a big flush in the dollar. If the dollar makes a comeback and trades above the 20 days moving average again, and it breaks out, I think gold is going to go back within the consolidation range again. The gold miners, on the other hand, GDX, got outside of range. We got a pop above the yellow line that you see as resistance. We closed above the 20 days moving average in white. We closed above 27.24 as resistance. The next stop could be the upper Bollinger Bands at around 28. So if the dollar remains weak, say Monday, Tuesday, until Jerome Powell begins to testify, I think the gold miners could make the journey all the way to the upper Bollinger Bands. And then we have to consider booking profits, at least if you have some exposure in NEM new mount. The SLV is the same thing, daily chart. We talked about the falling wedge that could produce a breakout if the dollar trades weaker on Friday. We got the breakout. We're above the 20 days moving average. Momentum is staying bullish in the MACD, but again, we are within tighter Bollinger Bands. So my expectations are gold and silver can trade within these Bollinger Bands, really tight range, but they can't expand them and trade higher or lower until we see a decisive move in the US dollar. That's not going to happen without the Fed getting out of the way first. You look at UK oil, Brent oil, what do we see here? On the weekly chart, bull flag above the 20 weeks moving average. We see momentum on the MACD, on the RSI, and the Vortex all firming up. Of course, resistance comes at 89.14, so 90 will be probably a point of resistance in UK oil, Brent oil. But depending on the tailwinds, it could expand these Bollinger Bands higher. So for now, we're going to stay with the bullish side for energy. You look at the XLE, the energy ETF weekly chart, we're above 83.87, above the 20 days moving average, above the sloping line of resistance. You can see that the momentum has now turned bullish in the MACD and the RSI and the Vortex, although we have resistance coming out really near at around 88.61, the upper Bollinger Bands. But for now, we're going to stay in the bullish side on energy. Likewise, if you look at the refiners ETF, CRAK crack. This is the weekly chart. We made a break above the sloping line. We're at the highs again. Faced a little bit of resistance at the upper Bollinger Bands on the weekly chart. But we went down in a retest of the sloping line of resistance, now of support. And the test was a success at least so far. So for now, we want to stick with the refiners. We want to stick with energy until proven otherwise. You look at the 10-year yield daily chart. What do we see here? We lost the 20 days moving average. We lost 4.2. And you look at the MACD indicator. We're now turning bearish. You might say, wait a minute here, but yields are going down. What's up with that? You got to understand that we have support coming out really fast, really soon at the lower Bollinger Bands. The other thing you got to keep in mind, you look at the weekly chart, the momentum there is turning from bearish to bullish still. You need to see more damage in the daily chart to eliminate the possibility that in the weekly chart, the 10-year yield is actually making a turn from bearish to bullish and about to cross the 20 weeks moving average. So the Fed becomes really important this month of March. If we look at yield-sensitive ETFs and charts, beginning with the XHB home builders, that continues to go higher. As yields go down in the daily chart, we see more and more gains in the XHB. It would require the 10-year yield to pop above the 20 weeks moving average, and we see a change in the narrative by the Fed for the XHB to make a correction. Maybe that's going to happen at some point soon. When the RSI becomes really overbought, we will see a big pullback rapidly to the 20 days moving average you can see in white here at around 99.5. By that time, it could be 100. And then we'll take it from there depending on what yields do. The IYR real estate ETF, it's been in that consolidation range, building the energy to change from bearish to bullish, as you can see in the MACD indicator. With a drop in yields on Friday, the IYR found the energy to trade above the 20 days moving average in white and expand the Bollinger Bands higher. For now, the IYR is trading bullish. Until we see yields coming back up, then the IYR will top at some point and begin to turn around. And let's see how it reacts to the next resistance at around 90.5. If it finds some resistance at that point, begins to turn around and we see yields going higher, we can take a short in the IYR. But for now, the chart is pointing for more gains to come. If we look at the KRE, regional banks also yield sensitive, but not really tradable right now. You look at the MACD, it is a battlefield. There is no clear winner between the bullish and bearish momentum. You look at the Bollinger Bands, and the range is really tight, so you're not going to make a major move one way or the other without a gap higher or a gap down based on New York Community Bank collapsing or a rescue in New York Community Bank. But for now, we're below the 20 days moving average again. If you bought based on the crossing and the closing above the 20 on Thursday, you got fooled. If you shorted now that we're below the 20 on Friday, you could be fooled again. So not interested in this chart, at least for now. If we look at the VIX weekly chart, the momentum remains positive, as you can see in the MACD and the RSI and the Vortex. But we closed below the 20 weeks moving average. You're not going to go long the VIX until we have a weekly closing above the 20 moving average. This could happen in the month of March. It is the month of the VIX, but unless you see that closing, or at least heading toward that closing, then you can't go long the VIX. When you see it, you can go long the VIX or begin buying some SPY puts. When we look at Apple, the big kahuna, the first thing that comes in mind looking at the daily chart, the upcoming death cross by the white line going below the blue. The white is the 20 days moving average. The blue is the 200, a major sign for weakness. Now, the big kahuna has some support at the lower Bollinger Bands and it caught a rebound on Friday. One thing you got to keep in mind here is give the big kahuna the benefit of the doubt that it might make some recovery. So if we zoom in to a 15 minutes chart, we closed below 180. 180 has been a critical line. Closing below is a major bearish sign. But again, give it the benefit of the doubt. This is why I have my line not at 180, but 179.25. Because this could be a cup and handle pattern, but we see a recovery in Apple comes Monday. But boy, if it closes below 179.25 by Monday or the end of the week, for that matter, then we go to the weekly chart. What do we see here? We're below the 20 weeks moving average. Momentum is negative across the board. We could see the outlook we've been talking about since the year began, which is you fill the gap, then you come down in an inverse ABC pattern to the lower Bollinger Bands at around 171. So it's an important week for Apple, a make or break sort of. Then we have Tesla, the souffle daily chart. You look at the daily chart above the 20 days moving average, forming a bull flag pattern. So far, so good. We have some resistance at the upper Bollinger Bands, but those are expanding as we speak. You zoom into the hourly chart, you can see the repeated pattern of a seller showing up above 200 and dumping the stock over and over and over again. Closing on Friday, we got a bull flag. We closed above 202.5. So for now, Tesla bulls have the upper hand. But if we begin to lose 202.5, I'm not worried. You begin to lose 199.90, okay, weakness. The same pattern showing up of the seller above 20. You lose 196.26. By losing, we mean closing below by the end of the day. Okay, now I'm interested in buying puts, betting on Tesla falling apart, giving up the pursuit of closing the gap from the drop after earnings. You lose 190.59. Okay, now I'm going short big time. And I'm aiming for 180, 175. NVIDIA, an hourly chart, what do we see here? We talked about that we don't have a reversal in NVIDIA until we see a loss of 771.62. That held as support. So we go back to the daily chart when we talk about the time frames. Look at what's happening in the hourly MACD. All of this consolidation is cooling off the bullish momentum. And the bearish momentum has been happening while the chart been consolidating, not going down. Usually that leads to the end of bearish momentum in the hourly chart, beginning of the new bullish momentum. We see the chart heading back to make newer highs. On the daily chart, we've been talking about the possibility of a bull flag. It appears for now that it is playing out, but here's the problem. We have the highs, and then we have 771.62 as support. We break above the highs, we're going with the 1,000 calls. you can pick your expiration date no further than the April monthly expiration. Preferably go short term with the 15th. And it's in, out, hello, goodbye. You make a quick buck, you close it, you're done. If we lose 771.62, then you want to go with the 700 puts. In that case, since the downside is more plentiful than the upside, how do we know that? Look at the Bollinger Bands. The upper are tight, so resistance is near. It's going to make it hard for the chart to just keep expanding the Bollinger Bands higher aggressively. But if it falls apart, it could fall big to the 20 days moving average, then the lower Bollinger Band. So if we see a loss of 771.62, we want to go with the 700 puts. You can go longer. You can go to the April expiration this time around. You can close it before, of course. But since technically the downside is more plentiful than the upside, we can go with a longer expiration date. AMD weekly chart. What do we see here? Way overbloated at the highs. You look at the RSI, you look at the MACD, you look at the Bollinger Bands. It is way too hot. And one of the reasons that I got rid of the position, even though you could argue that this is a bull flag that is playing out, we see more breakout in AMD, got it. But the last time we've seen this look, it didn't end up pretty good for AMD. We got a correction right away. And keep in mind that the report was not really that good. We'll go over it in my portfolio review. So I'm happy to get rid of the shares at 200 a pop. Maybe if it goes down, we'll consider re-adding, but for now, if you must chase any chip, would you really chase AMD at these looks in the RSI and MACD and Bollinger Bands? Maybe not. Then you look at Marvell, MRVL, a similar look with AMD, but this one is not overbought. It is playing a bull flag pattern. RSI is not overbought. MACD is not overbought. I'm more comfortable chasing some Marvell versus AMD at this point. With that being said, the problem with these individual chip names, they're trading based on an ETF. So if the big guys go down, such as NVIDIA, AMD, and most notably ARM, Supermicro, they could take down Marvell with them too. So just keep that in mind if you decide to chase. Understand that there is risk involved with that, even though you're picking a name that is not really overbought. Moving on to tulips. Bitcoin, what do we see here? On the 2 hours chart, we got the crypto whale dumping at the point of around 64,000. The challenge now becomes, can the traders buy the dip and make it above that number? Because what if the crypto whale comes back, dumping at the same number? That's something you got to keep in mind. We look at the daily chart for BTC. It is consolidating in a bull flag pattern, allowing the Bollinger Bands to expand, allowing the RSI to cool off a little bit. You got support 58,325. You got resistance at around the 64 line, where we've seen crypto whale dumping. Then you look at the proxies. Coinbase, the daily chart, a similar look with BTC. Consolidating in a bull flag, allowing the Bollinger Bands to expand. The RSI is not as hot as we've seen in Bitcoin. Of course, it's going to trade hand to hand to what happens to Bitcoin. But for now, Bitcoin is consolidating in a bull flag. The assumption is it goes higher, and Coinbase will go higher with it. You look at the weekly chart for Coinbase. We talked about this before, retouching support at the 20 weeks moving average, forming the cup and handle pattern. And now we have resistance at around 206.79. We close above from a weekly standpoint, then we have higher highs to come. Otherwise, if there is a failure and the crypto whale shows up again, dumping Bitcoin, it could be the end of the journey for Coinbase. Now, here's the problem. Mara, this is a miner. You can see that it's not looking as Bitcoin or Coinbase. It's underperforming. And the reason is its fundamentals are not really that good. It's just been trading higher in empathy with Bitcoin going higher. It is now finding support at the 20 days moving average. I would say if there is a correction in Bitcoin, you gotta play it with Mara. And you go way out of the money puts, in this case 16, 15 puts, because it could be a sharp drop if Bitcoin corrects. And the reason is a lot of folks now realize that the miners is not the place you want to be in, chasing Bitcoin. If Bitcoin does a correction, then Mara goes down. Now, if Bitcoin goes higher again, we could see a recovery, but understand that we might see sellers as this one recovers, because a lot of holders will now begin to migrate from the miners to the ETF. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, we have Philly Fed President Harker speaking. Then Tuesday, the 5th, we have factory orders, the ISM Services Survey. Then we have the Fed Chair of Supervision, Michael Barr, speaking. The most important day comes Wednesday, March 6th. We have the ADP Employment Report. Then we have the testimony by Jerome Powell in Congress. After that comes the U.S. wholesale inventories, job openings, more speeches by San Francisco Fed zombie Mary Daly and Minneapolis Fed zombie Neil Kashkari. Of course, between these speeches comes the Federal Reserve Beige Book. And Thursday, March 7th, we have initial jobless claims. Comes on top of a revision for U.S. productivity. The trade balance. Day number 2 of the testimony by Zombie Powell to Congress. Then we have Zombie from Cleveland, Loretta Mister. After that comes consumer credit. And lastly, Friday, March 8th, another important day. New York Fed Zombie Williams. After that comes U.S. non-farm payrolls, along with the unemployment rate and hourly wages. As you can see, critical week from the Fed and macro perspectives. And this is going to have an impact on the dollar and bond yields, which will move the market from positioning and chasing bubbles to more concentration on the Federal Reserve policy and macro. We're going to cover it all. But for now, this is all I got for you. If you found the video informative, please press the like button, subscribe, leave us a nice comment, consider becoming a member, either here on YouTube or Patreon. But this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
What's that?
It's a dream.
What is it?
The Federal Reserve Bank.